Welcome to the deep dive. Today, we are strapping in for a really high-velocity look at one of Latin America's true behemoths, Mercado Libre. You probably know it by its ticker, MELI.
That's right.
And if you're trying to understand the absolutely critical point this company is at in 2026, you're in exactly the right place. We're going to cut through the noise and get straight to what they have to nail this year.
Yeah, for years, Mercado Libre has just been this, this gold standard for growth, riding these huge digitization tailwinds all across Latin America.
A massive region.
But every single one of these exponential growth stories, they eventually hit a kind of phase change. The research we've synthesized for you, it paints a picture of a company that's still growing fast, for sure, but it's facing a major test.
That test is what?
It's the transition from just being a high-growth platform to something far more sustainable.
Okay, so let's unpack that, the core tension. Our mission today is to really distill this major conflict we see in all the analysis. Can MELI's famously fast growth also be durable and, crucially, consistently profitable?
Exactly. They have to shift the narrative.
From a pure growth story to proving they're a durable compounder.
Durable compounder, exactly. And when we say that, we're not just talking about a company that can grow its revenue quickly. We mean a business that can reliably grow revenue and its profit margins, over decades.
Right.
And for MELI, that means proving their massive scale isn't sort of permanently tied to these razor-thin margins that competition or logistics costs are forcing on them.
And looking back, 2025 really just put a spotlight on all this, didn't it?
Yeah.
It accelerated the urgency.
Oh, it absolutely did. The consensus view, what all the research really agrees on, is that 2025 was the definitive end of that simple, tailwind-driven growth story.
The easy days are over.
Absolutely. Margins came under immediate visible pressure. Competition got way more intense, and we'll definitely get to Shopee and Temu and their capital needs for logistics and credit. They just shot up.
So that dynamic just raises the execution bar for 2026 to, almost impossible heights.
It's incredibly high.
Yeah. Which is why we've got to focus on these 4 areas where execution is just non-negotiable this year. Let's jump in. Mandate number 1. The tightrope walk between growth and margin discipline. Because the sources all show the profitability took a serious hit last year, and it was mostly a consequence of, defending the fortress.
That's the perfect way to put it. That was the key trade-off they made. They went all in on volume, on user engagement, on market share above everything else.
Which is a common defensive play, right?
It is. It's a necessary one when new subsidized rivals show up. But man, is it an expensive one. And the source material details exactly how it hurt. They expanded free shipping, especially in Brazil, their biggest market.
Right.
They just absorbed higher logistics costs to be faster, and they leaned heavily into promotions and discounts.
So, okay, the defensive strategy, it worked. It kept volume up. It held the competitors back. But now the market is saying, okay, that defense was expensive. Show us the path back to profitability.
Precisely. The test for 2026 is stabilization, or, what analysts are calling margin control. Investors are willing to accept lower margins than a few years ago. That's fine. But they need to see real evidence that margins can stabilize.
Or at least stop falling.
At the very least, stop deteriorating and do it without sacrificing that crucial top-line growth. It's an incredibly delicate balance.
And this is where it gets really interesting for me. How do they actually do that? What are the internal levers they can pull to fight back against all this external pressure from rivals just subsidizing everything?
There are 3 specific mechanisms that really stand out in the sources. First is logistics efficiency. They have this huge proprietary fulfillment network, and they need to make it cheaper to run per order.
Okay, so not just bigger, but smarter.
Exactly. The sources detail efforts to, centralize their cross-docking operations and deploy their own AI for routing to cut that last-mile cost per package. That efficiency gain, that specific metric, that's what investors need to see.
So it's not enough to have the warehouses. You have to operate them cheaper than anyone else can.
That's the game. The second lever is improving their take rates. That's the percentage of each transaction they get to keep from their sellers.
But there's a ceiling on that, right? You can only push sellers so far before they start looking at cheaper alternatives like you mentioned, Temu.
100%. The trick is to raise rates on services that sellers see real value in. And that leads to the third lever.
Which is advertising.
Advertising monetization, yeah. They have to move from just being a place to sell stuff to a full-blown advertising and marketing engine, kind of like what Amazon has done.
The ultimate goal here for that compounder story is proving they can grow without just permanently subsidizing every new transaction.
That's the whole story. If they fail that test, If margins keep sliding even as they get bigger, then the market starts to question the fundamental long-term economics of their entire e-commerce model.
And how bad could that get if the economics don't improve?
It leads to what we call absorbing permanent costs. If getting bigger doesn't make you more efficient, it just means you're absorbing more losses more quickly. E-commerce is high volume, but it's often low margin.
Which is why we need to move on to their second engine, the one that's supposed to provide the profit ballast.
Mercado Pago.
Exactly. If e-commerce is facing this margin pressure, then their lifeline, their profitable counterweight, it has to be the fintech engine.
So let's transition to Mercado Pago. The sources show, just rapid and aggressive expansion there in 2025.
Payments, assets under management, lending, it was across the board. The expansion has been remarkable. And what's really encouraging is that they saw improved short-term credit quality, even though they're operating in, a pretty volatile region. They're using their own data on user spending to underwrite loans better than the traditional banks can.
That's a good sign for sure, but fintech and lending specifically, it's always a double-edged sword. It absolutely is. Rapid credit expansion looks fantastic for your growth numbers, but lending means putting your own balance sheet at risk. You're using your own capital.
And that risk gets amplified if there's a sudden economic slowdown in Brazil or Mexico.
It gets amplified massively, so the 2026 mandate for Pago is pretty clear.
They have to prove they can scale lending without, blowing up the balance sheet.
That's it, precisely. Mercado Libre has to prove its credit growth is sustainable and disciplined, not just fast. That means showing really stringent credit discipline as the loan book grows and, crucially, keeping those delinquency rates under control.
But, Latin America is inherently volatile.
Yeah.
So are the sources giving them credit for having better data and risk models than the old banks? Or is the consensus just that, hey, they're getting lucky with a decent macro environment right now?
It's a bit of both, really. The belief is that their digital data advantage, knowing exactly how often a seller sells or how a buyer pays off installments, that gives them a superior ability to underwrite loans. But the reports also highlight that if macro conditions really fall off a cliff, even the best data models in the world will fail. So the payoff has to be high enough to justify that risk.
But if they nail this, if Mercado Pago delivers both that fast growth and sustained clean profitability, it really does act as that perfect counterweight, doesn't it?
It's a powerful financial stabilizer. It completely offsets the thin margins from e-commerce that we just talked about.
And if it fails?
If it fails and they start struggling with credit quality, the whole risk profile of the entire MELI group just shoots up. They'd basically be doubling down on risk just as their other engine is tightening up.
The execution here is just so vital for investor confidence.
It's everything.
Speaking of execution and huge capital bets, let's talk about the spending. Our third critical area is their aggressive investment strategy. We are talking billions of dollars being poured into infrastructure. It's staggering.
It is massive capital deployment. It's a good reminder that MELI isn't just an app. It's, you could argue, one of the largest private infrastructure projects in the entire region.
So where's the money going?
The sources highlight big investments in physical logistics hubs, huge tech upgrades, and deep payment infrastructure across their core markets: Brazil, Mexico, Argentina.
And the strategic thinking makes perfect sense, right? Faster delivery, better reliability, deeper ecosystem. They're building the moat to keep out Shopee and the local players.
That's the hope. But heavy spending only matters if it leads to better outcomes. The real question for 2026 is whether all this reinvestment actually delivers operating leverage.
Reinvestment alone isn't the answer.
No. Execution has to follow immediately.
Can we clarify that for the listener? What do we mean by operating leverage in this specific context?
Okay, so operating leverage just means that as your revenue grows, the cost to handle each extra piece of business, one more order, one more delivery, one more payment, that cost goes down, or at least it grows slower than your revenue.
So every new dollar of revenue becomes more profitable than the last one.
Exactly. It doesn't just cover costs, it disproportionately flows straight to the bottom line. That's the proof that all the infrastructure spending is actually working.
So what are the key metrics investors are watching to see if that operating leverage is actually happening?
The analysis highlights three things. First, and this is the most critical, fulfillment costs per order have to be going down.
Okay.
Second, their tech spend needs to scale efficiently. It can't grow as fast as revenue, or the software isn't really making things cheaper. And third, incremental revenue has to translate into reliably higher contribution margins.
And if that doesn't happen,
Yeah.
if the heavy spending continues, but those efficiency gains don't show up.
Then that narrative, it shifts instantly from building the future to absorbing permanent costs.
And that's the line investors have to watch in 2026.
It's the whole ballgame. You want to see the long-term payoff, not just the upfront bill. The market is getting really impatient for proof that this massive physical build-out can actually achieve software-like returns.
Which brings us perfectly to our fourth and final challenge. The external pressures, the competitive reset. Competition isn't just some background noise anymore.
No, it's a fundamental shift.
It's a structural concern.
It absolutely is. It's a front and center structural concern. And we have three specific rivals that the sources identify hitting MELI from three totally different angles at the same time.
Okay, let's detail that triple threat.
You start with Shopee. They have actually surpassed MercadoLibre in Brazil in terms of raw order volume. That's a direct threat to MELI's dominance in their single biggest market.
And how are they doing that?
Competing on breadth of products and very often on subsidized shipping.
And then you have Temu, which is a totally different beast.
A completely different threat, yes.
Yeah.
Temu has successfully reset consumer expectations on price across the whole region. They basically trained consumers to expect things to be incredibly cheap.
Right, so people are less willing to pay a premium for anything, even for MELI speed or reliability.
And that shift in consumer psychology is the real headwind because it just forces margin compression on everyone in the market.
And then on the financial services side, the threat is coming from yet another direction.
Correct. You have Nubank, which continues to compete very aggressively for digital wallet users, for those primary banking relationships, and just general financial services customers. They are directly challenging Mercado Pago's user base.
So what does MELI have to prove in the face of all this? I mean, Latin America is huge. Surely there's room for more than one player.
There's certainly room for multiple players, that's true. MELI doesn't need to win every single battle. But they have to prove that all this competition won't lead to the permanent compression of margins across their entire ecosystem.
Both e-commerce and fintech.
Both. Are they fighting the volume battle with Shopee differently than the price battle with Temu?
That's a great question. And yes, implicitly, the strategy seems to be different for each. They're countering Temu with the quality and integration of their ecosystem. Faster delivery, better selection. And they're countering Shopee by trying to maintain an advantage in logistics, reliability, and monetization, ads and Pago services. They're trying to grow wallet share, not just market share.
So what are the signals that would restore market confidence in 2026 when it comes to competition?
We need to see signs of pricing rationality. We need to see less promotional intensity. If the whole sector just keeps relying on subsidies to compete, profitability for everyone is going to remain elusive.
Or if the promotions continue, we'd need to see MELI showing clear proof of better monetization per user.
Exactly. Getting more money from services, ads, and fintech for every single user they bring in.
So let's bring it all together. What does all this mean for the person listening to this deep dive?
I think we can synthesize these four critical points pretty clearly. Mercado Libre, it's still one of the most compelling long-term opportunities in the region. That ecosystem is so broad, so deeply embedded, and so hard to replicate. But like all the source material says, the easy subsidized growth phase is clearly over.
That's the key takeaway. 2026 is the year where they have to make that crucial transition to durable compounder status. And that requires them to nail these four things this year.
Okay, let's list them out one last time. First, defend your growth, but without sacrificing margins forever. They have to show that their internal efficiency can beat out external competitive spending.
Second, scale that really profitable fintech engine, Mercado Pago, but without compromising on credit quality. The growth has to be disciplined, not reckless.
Third, turn those billions of dollars of investment into real, verifiable operating leverage. Fulfillment costs must drop per order to prove that the model actually scales profitably.
And finally, compete aggressively, but don't let that competition fundamentally destroy the long-term economics of the business model.
And if they succeed on those four fronts, they make that transition from just a high-growth platform into that durable compounder status that the market really rewards.
And if they stumble,
we should probably expect more volatility and increased capital demands, even if the top-line revenue keeps going up.
I think for long-term investors, the sources make a really strong case that 2026 is less about how fast Mercado Libre grows and far more about how well it executes on these four strategic mandates. Execution is everything now.
Right, now that the tailwinds have died down.
Exactly.
And that leaves us with one final thought for you to tear on. If Temu and Shopee continue to drive consumer expectations based purely on heavy subsidies and just ultra-low prices, if they're basically training consumers to prioritize price above everything else, what does that imply about the long-term defensibility of MercadoLibre's massive investment in logistics?
What happens to your moat when your customers only care about the lowest price, regardless of who provides the speed or the quality?
The answer to that question will probably define the next decade for e-commerce in Latin America.
It certainly will.
Thanks for diving deep with us. We'll get you next time.